Today I would like to analyze Lululemon, one of the largest clothing brands in the world and one of the worst performing stocks in the last year. We are down around 42%, so we're gonna take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 26.36 billion US dollar. This makes Lululemon the 12th largest clothing company in the world by the market cap. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2021, the revenue was around 4.4 billion US dollar. This was a good growth around 10% from 2020. In 2022, we saw the very good growth around 42%. In 2023, we saw the very good growth around 29%. And then in 2024, we saw the good growth around 18%. So overall, I think in the last 5 years, we had a very good revenue growth. So it's a check here. The next thing we're looking for is the free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2021, the free cash flow was around 0.57 billion US dollar. This was a very strong growth, around 48% from 2020. In 2022, we saw the incredible growth around 73%. Then in 2023, we saw the strong decline around 67%. This is something we don't like to see. But then we had a strong comeback again in 2024 with the growth around 401%. So overall, I think this company had a very good free cash flow growth in the last 5 years. So it's also a check here, and we like to see that. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024, 1.64 billion. Then we're going to divide it with the current market cap, 26.36 billion. And then we're going to get the free cash flow yield for 2024. So the number we're going to get would be around 6.22%. And that's a very good free cash flow yield. Actually, it's over the 4% that we're looking for. So it's a check here. We can also take a look at the free cash flow assumptions for the next years. And we can see here in 2025 is around 1.58 billion. In 2026, around 1.27 billion. So a free cash flow decline. And in 2027, around 1.52 billion. So overall, I think these are pessimistic assumptions, so maybe the numbers can be better in the future, but let's assume for 2027 around 1.52 billion. Then we're going to divide it with the current market cap, 26.36 billion. And then we're going to get the free cash flow yield for 2027 with our free cash flow assumptions. So the number we're going to get would be around 5.76%. And that's still very good. I would say it's over the 4%. So it would also be a check here. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with a free cash flow in under 5 years. A very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. We can see here around 1.15 billion US dollar. Then we're going to add the short-term debt as well. So the short-term debt is around 0.25 billion. So then we're going to divide it with the current free cash flow, 1.64 billion. And then we're going to get the ratio that we're looking for. So the number we're going to get would be around 0.85. And that's a great number. It means in a little bit under 1 year, we can repay the debt with the free cash flow. So the check here, and we like to see that. We can also take a look at the cash on hand, how much money this company has in the bank. And we can see here it's around 2.24 billion. And that's a very good amount as well. So overall, I think this company has a very good balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. First, we're going to calculate the enterprise valuation. So this is the current market cap, 26.36 billion. We're going to add the debt as well, 1.4 billion. Then we're going to take minus the cash. So this is around 2.24 billion. And then we're going to divide it with the free cash flow. But first, we're going to get the enterprise valuation. So this is around 25.52. So this is how much the whole company is worth. So now we're going to divide it with the free cash flow. This is around 1.64. And then we're going to get the ratio that we're looking for. And that's around 15.56. And that's a great number actually. It's under the 25 that we're looking for. So the check here, and it's also an indication for undervaluation already. We can also calculate this number for 2027 with a more pessimistic free cash flow assumptions. So we're going to divide the enterprise valuation with the free cash flow assumptions of 1.52 billion. Then we're going to get a different ratio of around 16.78. And that's still very good, I would say, and again, an indication for undervaluation as well. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially if we think the company is undervalued. So we're going to take a look and we can see here, yes, this company does a lot of buybacks, sometimes even over 2%, and in 2024, nearly 3%. These are very good numbers, I would say, and I also think this company can afford it because they have a very good balance sheet, and I think this can help the stock price to increase as well. So it's a check here, and we like to see that. Can Lululemon stock be a good buy right now? One of the worst performing stocks in the last year. We are down around 42%. So let's start with a positive about this company. So I think this company had a great revenue growth in the last 5 years. They also had a very good free cash flow growth as well. This is something we really like to see. The balance sheet is also looking great with a low amount of debt and a good amount of cash on hand. The free cash yield around 6.22% is also very good. We like to see that. In 2027, with our free cash flow assumptions, the number would be around 5.76%, which is still very good in my opinion. The enterprise valuation to free cash flow ratio around 15.56 is also very good. We like to see that number under 25. So in 2027, with our free cash flow assumptions, this ratio would be around 16.78, which is still a very good number in my opinion. What I also like to see is the stock buybacks. This can help the stock price to increase as well. And I think this company can also afford it because they have a very good balance sheet. So overall, I think this company is very interesting right now. The financials look very good, and I think it can be an undervaluation right now, but only invest in this company if you also believe long-term in this brand. If you found this video helpful, don't forget to like and comment and subscribe for more content.